Hey everyone, Itai here, and welcome to another session of Deals Agent. And now let's discuss the AI market. So we can just ask Deals Agent natural language question. Let's ask, are today's market among the most concentrated in history? And Deals Agent pulls that from Capital Group and says, yes, the top 10 companies now approach 40% of the S&P 500, a level matched only a few times before. Similar extremes appeared in the US Nifty 50 era, which back then the top 10 hit 39% in 1964, and in Japan's 1980s boom. The difference today is thematic. The largest names, the Nvidia, the Microsoft, Amazon, and Micron, are tied to one theme. You guessed it, AI investment. So they can move together. There's correlation among them. Now, prior concentration episodes eventually broke down before returning to more balanced levels. Concentration isn't a timing tool, but it's a reminder that trees don't grow to the sky. So you see how Deals Agent gave you insight from the data, not just the data, insights from the data. Let's continue asking another question. Is AI concentration a global phenomenon? We know about the United States, but is it also a global phenomenon? And once again, Deals Agent gives you an answer, gives you the insight, tells you where it sourced it from Capital Group, and the answer is it is. The demand for specialized chips has pushed technology names in South Korea and Taiwan to record highs. The top 10 firms in the MSCI Emerging Markets Index now account for 41% of its market capitalization, with just three: SK Hynix, Samsung, and TSMC, making up 29% of the index. This is a higher concentration than the US, while Europe and developed markets outside the US remain far more diversified, which is where managers say real bargains are still available. Now let's ask, how does US GDP rely on AI spending? And once again, we get the insights, we get a graph, we see the source of the data, and the answer is heavily. Concentration risk reaches past the index into the real economy. The data center build out contributed close to 1% point of real GDP in the first 9 months of 2025, which the St. Louis Fed estimates that was about 39% of all US growth in that period. Think about it, 39% of all US growth is related to AI and specifically to data center build out. So that leaves earning and the wider economy exposed to an AI-led slowdown, since the profit pools all trace back to the same physical build-out. Roughly half of data center costs are semiconductors, with HVAC, power, water treatment, and transformers riding the same wave. Now let's ask, is AI fatigue hitting the bond market? And again, we see graphs and we see the insight that Deals Agent generates. Signs of strain are showing. A wave of AI-linked bond issuance has weighted on the debt of high-profile borrower, including Meta, Amazon, and SpaceX. Hyperscalers now make up roughly 4.8% of the total market value of the Bloomberg US Corporate Investment Grade Index, up 78% from the 2.7% a year earlier. The message is diversification. Bond prices carry more downside risk than upside, so some hyperscalers offer attractive yields against strong cash flows, while newer project financing structures warrant more caution. And now let's ask, what should investors do about it, right? That's what we care about. What should investors do about it? Once again, we see the insights, a call to rebalance and diversify. This is what Deals Agent is telling us, sourcing it from Capital Group. And the answer, the insights that we see are that the concentration in AI exposes a trade-off inside index investing. Cap-weighted funds are less diversified than many assume, and cheaper is not the same as safer. This isn't an argument against owning the companies driving the AI era. Many are extraordinary businesses, but at today's rates, benchmarks, and the passive strategies tracking them increasingly assume one set of outcomes will dominate, and this is a more balanced approach. Those are the practical steps. Measure what share of your holding sits in a handful of AI-linked names. add exposure to old economy sector alongside well-positioned companies outside the US, so geographic diversification and sector diversification, not just AI in the US. Review both intended and unintended risk across the portfolio. Be bold enough to own great businesses when fundamentals justify it, and to defer from the benchmark when risk and reward called for it. And be humble enough that no single theme, however powerful, dictates the shape of the portfolio. Everybody wants to jump on the AI bandwagon. Be humble. Don't let it drive your portfolio narrative. Hope that was interesting enough for you guys, and we'll see you soon. Take care. Bye-bye.